Why is it strictly forbidden for beginners to open a real account? It's not strictly forbidden for beginners to open a real account, but it's generally discouraged because it carries significant financial risk. Here's a detailed explanation of the reasons why beginners are advised to start with a demo or practice account before using real funds. 1. Lack of experience and knowledge. Beginners lack the practical experience and market knowledge that seasoned traders have developed. This can lead to impulsive decisions or mistakes, such as overtrading, misunderstanding leverage, or using improper risk management. Trading in the financial markets, stocks, forex, crypto, etc., requires a thorough understanding of technical and fundamental analysis, trading strategies, and market dynamics, which most beginners haven't fully mastered. 2. High risk of losing money. Without a solid understanding of the market, beginners are more likely to lose money, especially if they don't have a well-thought-out plan or strategy. Trading involves complex risk factors, and beginners are often not prepared to manage these. In fact, most new traders lose money in their first months, which can be demotivating and financially damaging. 3. Psychological challenges. Real trading involves emotions such as fear, greed, and anxiety, which can lead to irrational decisions. For instance, a beginner might hold on to a losing position, hoping it will turn around, which often leads to bigger losses. When real money is on the line, emotions can interfere with decision-making, making it hard to stick to a trading plan or use proper risk management. 4. Inadequate risk management skills. Proper risk management, setting stop-loss orders, position sizing, understanding leverage, is crucial to minimize losses, but beginners often lack this skill. Many beginners use excessive leverage, which amplifies both gains and losses. Leverage can lead to severe losses if used improperly, often wiping out accounts very quickly. 5. Overconfidence and lack of patience. New traders sometimes experience beginner's luck or see some initial success and may become overconfident, thinking they've mastered the market. This can lead to larger, riskier trades that may result in major losses. Trading success requires patience, which is hard to learn at the beginning. Many traders jump in with high expectations, which can lead to frustration and impulsive actions when results don't meet expectations. 6. No defined trading plan or strategy. Beginners typically lack a well-tested strategy or trading plan, meaning they may take trades based on gut feeling or random information. A clear plan includes entry and exit criteria, risk-reward ratios, and rules for managing trades. Without a plan, it's easy to get caught up in the market's ups and downs, leading to erratic trading and consistent losses. 7. Learning curve. Without financial pressure. Using a demo account allows beginners to learn trading mechanics and market behavior without financial pressure, which makes it easier to focus on learning and developing good habits. A practice account helps beginners test their strategies and understand how the market works without any financial consequences. This learning phase is essential before risking real capital. Conclusion. Opening a real account without sufficient knowledge, experience, and psychological preparation is risky and often leads to losses. Starting with a demo account gives beginners a safer environment to build confidence, develop skills, and refine their strategies, ultimately preparing them for the real market. Once they've established a track record of consistent success in the demo environment, they can consider switching to a real account with a small investment, gradually increasing it as they gain more experience and confidence.